Hello everyone, this is Dr.MIHIR Shah once again with another video. In this video, we are going to solve April 2023 University question paper under the subject Investment and Portfolio Management, also known as IAPM. Again, a very important video for all the TYBMS SEM-V student. In this video, we are going to take up all the practical problem sums that had appeared in April 23 question paper. So there were basically around 6 to 7 sums that had appeared. So we'll be picking out each and every sum. We'll see what kind of sum had been asked and how you need to solve them in the most easiest manner. Okay, Chalo, let us start one by one. For April 2023, the very first question was calculate under question 3a. Calculate beta for Apple Limited. They're giving you years, security return and market return. Okay, so now the columns that are required will be for Apple Limited. You will have years 1, 2, 3, 4, 5. The security return 17, 16, 17, 21, 24. Market return will be 20, 17, 18, 20 and 24. Sorry, 20 and 25. So first you note down and add up the total. So RS ka total was 95, RM ka total is 100. Once you get the total, we need to find the average. Okay, so RS bar will be RS ka total upon number of years, that is 5, and RM bar will be 100 divided by 5. So RS bar sigma RS 95 upon 5 came to 19. RM bar is sigma RM 100 upon 5 came to 20. Okay, now this is very important. You have to look here very carefully. Once you have got RM and RS, the next step is RS minus RS bar. So each and every value of RS minus 19. So 17 minus 19 negative 2, 16 minus 19 negative 3, 17 minus 19 negative 2, 21 minus 19 is positive 2, 24 minus 19 is 5. Next is RM minus RM bar. So now that is all the values of RM minus the RM bar. So 20 minus 20 is 0, 17 minus 20 negative 3, 18 minus 20 negative 2, 20 minus 20 is 0, 25 minus 20 is 5. Once you get that, now you need to multiply these two values. Okay, and that will be our next column, RS minus RS bar into RM into minus RM bar. 2 minus 0, 0, negative 3 into negative 3 is 9, negative 2, 4, anything into 0, 0, 5, 5 is 25, we add up, we got 38. And last, RM minus RM bar, the whole square. We need the square of those column. So 0 ka square 0, negative 3 is 9, negative 2 is 4, 0 is 0, 5 is 25, total came to 38. Once the table is ready, okay, we start finding the formula. 3 things we need to find. First is covariance, that is the second last column ka total upon n minus 1. So 38 upon 5 minus 1, so 38 upon 4 came to 9.5. Next we need to find standard deviation square m, that is the last column ka total upon n minus 1. So 38 minus 4, 38 divided by 4, which came to 9.5. Once you have both these values, we can apply beta. Beta is nothing but the covariance upon standard deviation square m. So 9.5 upon 9.5, it comes to 1. So the beta for the first sum is 1. Okay, so that is how you all have to solve the very first question based on beta. So you all can go through once and then we'll jump to the next sum. Okay, now the next question that had appeared in the paper was question 3b. The rate of return of stock Me2 and Re2 are given under different status, that is boom period, normal period, recession. You are required to calculate the expected return and standard deviation of both the stock. They are giving you the return, they are giving you the probability. We'll start with Me2 Limited. Okay, so particulars may we write the period, they are giving you boom, normal, recession. Probability may 0.3, 0.45 and 0.25. Under returns 35, 50 and 80. The first thing that you will need to find is the expected return. So we multiply them. The probability into return, that will give you P into R. So 35 into 0.3, 50 into 0.45 and 80 into 0.25, we get it as 10.5, 22.5 and 20 add up and we get the answer as 53. The total of P into R is nothing but our expected return, which comes to 53%. Now the next column, we need returns, that is R minus expected return. So R minus ER, so that will be 35 minus 53, 50 minus 53 and 80 minus 53. So we get negative 80, negative 3 and 27. Next will be the square of whatever we got the difference. So 18, negative 18 square, negative 3 square, negative 27 square. So we get it at 324, 9 and 729. Last step, the square whatever we got multiply with the probability. So 324 into 0.3, 9 into 0.45 and 729 into 0.25. We get the values as 97.2, 4.05, 182.25. The total of that comes to 283. That is nothing but the variance. So last standard deviation is nothing but the root of the variance. So square root of variance, that is the square root of the last column, square root of 283.5, which comes to 16.84. Okay, so we got the expected return and we got the standard deviation. Now this is for me to remember the values, because then we'll have to compare which one is the better among the two. Okay, now we'll start with the next one, that is RE2 limited. Under RE2, it is same columns we'll require. We have the particulars, boom, normal, recession, probabilities 0.3, 0.45, 0.25. Returns में 75, 55 and 51. Multiply 0. So we get 22.5, 24.75 and 12.75. Total comes to 60. So our expected return is 60%. Next is return minus expect, 75 minus 60, 55 minus 60 and 51 minus 60. We get 50, negative 5 and negative 9. Next, the square of them. So 15 ka square is 225, negative 5 is 25, 9 ka square is 81. Last step, whatever square into the probability, we get it 67.5, 11.25 and 20.25. Total comes to 99. So variance is 99. Standard deviation is nothing but the root of variance. So 99 ka root is 9.95. Now they didn't mention us whether which one is better or not. So we will end the sum here itself, because they only asked us to calculate. But if I had to give a statement, it was 53 and 16.84. Okay, 53 and 16.84. Whereas for the second one, it is 60%. So the returns are much more and the standard deviation is much lesser. So returns are more, risk is less. Companies, the second company, that is RE2 limited company, will be a better advisable company. Okay, so among the two, it is advisable to invest in RE2 limited, since the returns are higher and the risk is lower. Okay, chalo, everyone go through it once and then we'll jump to the next question. Okay, the next question. This is a 15-mark question. It is a lengthier sum as compared to the other one. Following is the information about shares of Amar and Anthony Limited in various conditions. Okay, so it was similar sum to the previous, but then they have given you, so they are asking you which company is more risk to invest. So we need to find the standard deviation for both the companies. Okay, so the probability are given, but then if you look carefully, they haven't given you the returns. They're giving you expected price. Okay, now in this question, in the paper, they missed out one statement that the current price is rupees 100. Okay, so there was misprint in this paper, so they didn't mention that the current price is 100 rupees. So remember, that is also a part of the question. Okay, so here the returns are not given, so we'll have to first find the return. So there's a formula for that. So we'll note down that formula first. So calculation of rate of return, it is expected price given in the question minus the present price, which I have written on top is 100, upon the present price, which is again 100, into 100. Okay, so we'll have to first convert all this expected price into rate of return, and based on that, then we can solve the sum. Okay, chalo, so it will be, for Amar it will be 140 minus 100 upon 100, 110 up minus 100 upon 100, 120 minus 100 upon 100, and 100 minus 100 upon 100. So we get the values as 40%, 10%, 20% and 0%. These rates, see that you'll note it down somewhere, because ahead with this we'll have to solve the sum. Okay, so 40, 10, 20 and 0. Same for Anthony, it is 150 minus 100 upon 100, 100 minus 100 upon 100, 120 minus 100 upon 100, 110 minus 100 upon 100. We get the values as 50, 0, 20 and 10. Now with the help of the first data 40, 10, 20 and 0, we're going to start with first Amar ka finding the expected return and standard deviation. So Amar ka, we wrote out the economic condition, high, low, stagnation and recession. The returns just now what we found, which was 40, 10, okay, 20 and 0. Okay, and the probability which they are giving you negative 0.3, 0.4, 0.2 and 0.1. We will multiply, we get PR, so it will be 12,440. Add up, we got 20, so our expected return for the sum is 20%. Next column will be R minus expected return, the 40 minus 20, okay, 10 minus 20, 20 minus 20 and 0 minus 20, so we get 20 minus 10, 0 and negative 20. Now we need the square of these numbers, so 400, 100, 0, 400, and last we need to multiply the square with the probability. Okay, so 400 into 0.3, 100 into 04, 0 into 0.2 and 400 into 0.1. We get the value as 120, 40, 0, 40. Total comes to 200. Once we get 200, this is nothing but the variance. So standard deviation is the root of variance, which is root of 200, which comes to 14.14. Same way, okay, this was for Amar. Same way we will find for Anthony. So Anthony ka again, the returns that we had recently found. Okay, so see, we found the returns from here. I'll just go backward. We found 50, 0, 20 and 10. Okay, so 50, 0, 20, 10. The probabilities are same, 0.3, 0.4, 0.2, 0.1. Multiply 15, 0, 4, 1. Total comes to 20. Now all your returns minus 20, so it will become, okay, expected return is 20. Okay, so now all your returns minus 20, 50 minus 20, 30, 0 minus 20 is negative 20, 20 minus 20 is 0, 10 minus 20 is negative 10. The square 900, 400, 0, 100. Now this multiply with the probability, we get it as 270, 160, 0 and 10. Total comes to 440, so the variance is 440. So standard deviation is the root of variance, which comes to 20.97. Now when we compare both, the expected returns are same, so no issues wherever you invest, but as per the standard deviation, Amar is much less riskier as compared to Anthony. So Anthony is more risky. So it is, the question there, which company has more risk? So the answer will be Anthony Limited has more risk. So that's the first part of the solution. You all can go through it once and then we'll start with the second part of the question. Okay, now the second part, will your decision change if the probabilities are changed? Okay, so we are changing the probability, the same sum, you have to redo the entire sum but with the new probabilities. So if probabilities are changed, the rate remains same, 40, 10, 20, the probability will change. Okay, so then now again the same, after the same procedure, we multiply, we get 12, 2, 6, 0, total comes to 20, expected return is 20. Now all your returns minus expected, so it will become 20, 40 minus 20 is 20, 10 minus 20 negative 10, 20 minus 20 is 0, 0 minus 20 is negative 20. The square 400, 100, 0, 400, multiply that with the probability, we get the values as 120 is 20, 0 and 80, total comes to 220. So standard deviation is the root of 220, which is 14.83 for Amar Limited. Same way we have to now find for Anthony Limited. So same logic, okay, 50, 0, 20, 10 was their returns. Now the probability, the new returns, the new probability, we multiply, we get 15, 0, 6 and 2, total comes to 23, expected return is 23. Now all your R minus 23, so 50 minus 23, 0 minus 23, 20 minus 23 and 10 minus 23, we get the values as 27, 23, 3 and negative 30. So these are all negative values. Square of that, 729, 529, 9 and 169. All these multiply with the probability, we get the amounts as 218.7, 105.8, 2.7, 33.8, total 361. So that's the variance. Standard deviation is the root of variance, which comes to 19. So now if you compare in both the parts, the standard deviation of the second one is still higher. So again we'll say the Anthony is more risky and the decision will still remain the same. So the question was, will your decision change if probabilities are changed? So no, the decision will still remain the same. So this was question number 3. Okay, you all can go through it once. Okay, next was question number 4. This was based on ratio analysis. They're giving you equity, preference, profit after tax, proposed dividend and market price, and they're asking us to find number 1 earning per share, Harsh Limited and Ketan. So we'll note down earning per share ka formula is net profit after tax given minus preference dividend. So we'll have to take preference share per dividend upon number of shares. Again we take 4 lakhs divided by the face value, we'll get the number of shares. So the value was net profit after tax was 10 lakhs minus preference dividend. 16 lakh ka 10% is 1 lakh 60 divided by the number of shares. 40 lakhs divided by 100, which is 40,000. So you divide, you got the rate as 21. Same way for Ketan, it would be 14 lakhs minus 20 lakh ka 10% is 2 lakhs. 50 lakhs divided by 100 is 50,000. You divide, you get the amount as 24. Okay, next was earning per share formula, market price upon earning per share. Market price is 140 and 156. Earning per share we just now found. So 140 upon 21, 156 upon 24, we got it as 6.67 and 6.5. Third, dividend payout formula is dividend per share upon EPS into 100. Our dividend per share ka formula, okay, remember dividend per share is not given, so we'll take proposed dividend. Okay, proposed dividend is 7 lakh and 8 lakhs divided by the number of shares. So 7 lakh divided by 40,000, we got it as 17.5. 8 lakh divided by 50,000, we got it as 16. Upon earning per share we already found into 100, so we got 83% and 66.67%. Next is return on equity share. Formula is net profit after tax minus preference dividend upon equity share capital into 100. So numerators, so we already had got it here. So it was 10 lakh minus 1 lakh 60 divided by 40 lakhs into 100. And then 14 lakhs minus 2 lakhs upon 50 lakhs into 100. So we got the value as 21% and 24%. Okay. And last, they had asked us to find dividend yield ratio. The formula is dividend per share, which we have already found, 17.5 and 16. Okay, upon market price 140 and 156 into 100. So we get the answer as 12.5% and 10.26%. Okay, so based on EPS, they tell you which one is better. Based on EPS, Ketan is better. Based on price earning ratio, Harsh is better. Dividend payout, say Harsh is better. Return on equity capital, Ketan ka share is better. And based on dividend yield, again Harsh Limited is better. So that is the conclusion that you all can make for each and every ratio. So this was the sum based on ratio. You all can go through it once. Okay, the next question was based on the question number 5A. The information for 3 portfolios are given: Doraemon, Popeye and Tom, and index market is given, market index. The average return, beta, standard deviation is given, and risk-free return has been given. They are asking you to find the Sharpe and Trenor measure. So I made a table. Under measure we write Sharpe formula is risk return minus risk-free return upon standard deviation. So just take the values and substitute. So it will be 13 minus 10 divided by 0.4. 14 minus 10 divided by 0.35, 16 minus 10 divided by 0.25, and 15 minus 10 divided by 0.3. We get the values as 7.5, 11.43, 24 and 16.67. Same way we need to find for Trenor. Formula is return minus risk-free return upon beta. So 13 minus 10 divided by 0.8, 14 minus 10 divided by 0.9, 16 minus 10 divided by 1.2, and 15 minus 10 divided by 0.1 or 1.0. We get the answer as 3.75, 4.44, 5 and 5. Okay, so that is how you will have to solve the sum based on Sharpian Reynolds measure. You can note it once. Okay, after this, the last question, 5b. The expected return and betas are given, and if the risk-free return is 7, market return is 12, calculate the return under IAPM method for all and say whether it is undervalued or overvalued or at par. So first, for Axis, the return ka formula risk-free return 7 in plus beta 1.6, RM was 12 minus risk-free 7, so 12 minus 7 into 1.6, whatever answer plus 7 came 15%. For Kotak, same, it would be 12 minus 7 into 1.4, whatever answer plus 7 came to 14%. And for HDFC, it was 12 minus 7 into 0.8 plus 7 came to 11%. So based on that, we just have to make the final statement. Remember, whenever an actual is lesser than the expected, it is overvalued. When the actual is more than expected, it is undervalued. And if it is same, it is at par. So that will be the final conclusion of the sum. Chalo, you all can note it down once. Okay, chalo, I hope everyone have understood that. With that, we will be ending this video here. Thank you.